welcome to the Viking Wealth Show and Multifamily Freedom webcast. I'm your host, Ravi Gupta. Today, we are in uncertain times. The stock market is volatile, inflation is on the rise, wages, gas prices, interest rates are going up, real estate prices are going through the roof. All of this is happening while the Ukrainian-Russian war and the COVID pandemic are looming in the background. How do we make sense out of all this? Should we be buying and selling assets? Should we hunker down and keep cash on hand? How do we navigate the stock market? Well, that's why we have Greg Dickerson joining us today. Greg is a serial entrepreneur, real estate developer, coach, and mentor. He has bought and developed and sold over 250 million in real estate assets, built and renovated hundreds of custom homes and commercial buildings, developed residential and mixed-use subdivisions, and started 12 different companies from the ground up. Greg currently coaches and mentors some of the top entrepreneurs, real estate investors, and real estate developers around the world, helping them start, grow, and scale their businesses, raise more capital, and do bigger deals. Greg's current clients have over 2 billion of assets under management and deals in progress. Greg is an expert on the topic of entrepreneurship, leadership, and real estate, and is regularly interviewed on some of the top real estate investing and business podcasts today. And I can personally say that I've known Greg for years now, and whenever I'm uncertain, I turn to him because he has the uncanny gift to process a tremendous amount of information and advise with amazing clarity. So that being said, welcome, Greg.
Hey, Ravi, thanks for having me.
Absolutely. So let's get right to it. I really enjoy your takes on just the general state of the economy. So can you tell us currently what's happening in the market right now, and then maybe just in general terms, and then focus on multifamily real estate?
Yeah, so the economy, we're in a major shift right now. The tipping point of coming off of the biggest quantitative easing, easy monetary policy that we've seen in the history of the Fed since 2008 and 9, great financial crisis. It's been basically almost zero interest rate policy and QE. So for the first time since then, we're going into QT and we're raising interest rates in the face of the highest inflation that the country's faced in a long time. So we've got 5 things looking at us right now from an economic headwind standpoint. You've got inflation. Obviously, we all know the real effective rate of inflation at the consumer level is in the double digits, probably the high double digits when you include gas and housing and just all of the things, food, all of the things that we consume on a day-to-day basis that drives the economy globally. So that's the number one thing that we're facing right now that's creating headwinds for the economy. And then you have the Fed rate policy. Like I said, we have QT now, meaning the Fed is no longer going to be pumping liquidity into the economy. And we have rising rates. So the Fed has to raise rates to try to get a hold of inflation. They feel like the economy is strong enough to significantly raise rates without creating a problem. You also have the pandemic still rearing its ugly head in Asia and Europe. China is on lockdown in a lot of areas, which is creating some more supply chain bottlenecks and things like that, which is also going to help, increase and add to inflationary concerns. And then, as you mentioned, we have the war in Ukraine and the potential for a global world war breaking out. So we haven't seen anything like that for 80 years. So, these are the things that the economy is looking at. It's the stuff that the investors are looking at and the things that are going to drive decisions, monetary policy, and our decisions at the consumer level moving forward based on the data and the repercussions of all of these things, which, by the way, the markets haven't priced in any of that. All the markets have priced in so far is that quarter-point rate hike. They have not priced in the effects of anything I just discussed.
So overall, you're saying things are looking good. Is that
absolutely.
Is that okay? Okay, good. I just want to make sure I got it correct. Okay, well, thank you for that.
You're kidding, right?
Yeah, I'm absolutely kidding. That's not the truth. I mean, there's a lot going on, a lot of good things.
Yeah, it's just uncertainty. It's just so good times never last, bull markets. Bad times never last, bear markets, right? It's peaks and valleys and cycles. Obviously, the worst thing that we're potentially facing is a global nuclear conflict. We haven't faced that since the Cuban Missile Crisis. This is a real threat and a real situation right now. So that's very different than anything we've ever faced. But these other issues are cyclical, right? It's peaks and valleys. So, it's not doom and gloom. It's just understanding the environment you're in and, calculating risk, protecting yourself. What is risk? Risk is preservation of capital. Risk management is preservation of capital. So that's the first thing that you need to be thinking about and looking at all times is understanding risk, because many people probably a lot of people on this call today have never seen a bear market. They've seen market go up only. They've seen QE only. They've seen zero interest rate policy only. They've seen zero risk environment. That's what we've been in since 2009 and 10. That's why everything is shot through the roof and why assets are in a mega bubble all around the world at all levels. Okay.
And there's a lot of info you packed in there. In fact, just exactly what you spoke about is what we're going to talk about, and we're going to break it down into multiple levels. So if you didn't understand some of that, don't worry, guys. We'll get to it. So let's just talk about basics. Now, you mentioned QT and QE, and for those who don't understand those concepts, could you just explain those in a nutshell?
Yeah, quantitative easing. So that's, where the Fed, so monetary policy is one thing, that's interest rates. And quantitative easing is where the Fed purchases assets, either treasury bonds or mortgage-backed securities to put liquidity into the market. And that's been our problem for the last, 8, 9, 10 years is we have a liquidity crisis, too much liquidity. So QT is how the Fed pulls liquidity out of the market by offloading those assets back into the market. So they buy treasuries and bonds from banks and investors to put, liquidity into the market so that credit loosens and there's money flowing in the economy to be lent out. So to reverse that, you have to sell your assets and suck the liquidity back out of the market and put those assets back out there.
Okay. So just, kind of to simplify it even further, it's, quantitative easing is basically the process of printing money and purchasing assets, and then quantitative tightening is selling those assets and then pulling that money back.
Yeah, so even easier than that. QE is pumping liquidity into the markets. That's why you've been able to borrow so much money so easily. QT is pulling liquidity out of the markets, which tightens credit, meaning it's going to get more difficult to borrow money.
Now, that, with those factors in place, I mean, is it possible that the quantitative tightening will have such an effect that all the capital or a majority of the capital that was pumped into the economy is pulled back? I mean, is that possible? Does that happen?
Well, it's the Fed's balance sheet, so it's trillions of dollars. So that's what they're
Right.
after. They need to unload trillions of dollars back into the market. That's what the markets are more afraid of right now than the interest rate policy, because that tightens credit, which shrinks the amount of capital that's available, which means deals don't get done, companies can't borrow, things like that. So, and putting that together at the same time you're raising rates. Last time we saw anything potentially like that was 2017, 2018, and you saw what happened there. The markets came to a screeching halt, sold off about 20%. The real estate market came to a screeching halt. So it was pretty, interesting times, and you're seeing the bond markets now react to the potential of rising interest rates and QT.
Okay.
The flight to safety. So people buying bonds, right, and bond rates going up. That's because investors are looking at the safety play. They're right, expecting, poor economic conditions. So they want to buy bonds to kind of hedge inflationary environment and tight credit.
Okay. Excellent. Okay. So that's one of the topics we'll hit up in just a little bit. Let's start off and get to a little bit more detail about the war. This is a big question, important question that we get often is, how does the Ukrainian war affect the market? So what is your take on that?
So the issues of the war are, normally wars aren't that, don't impact markets as much, but this one's very different because it's impacting commodities. So wheat, fertilizers, and now with the sanctions on Russia and their elimination from the global economy, albeit they were a small player in the global economy, their economy is not that big, but it's still an impact on other countries in Europe. They were a big player in Europe. They're not a big player globally in terms of their GDP. So, we're going to see significant impact from commodities, which we're already seeing in, fuel prices, oil prices, energy costs, things like that, especially as we pivot away from Russia and take them out of the world economy. You're seeing, obviously they're the largest wheat producers, Ukraine, and they're still projecting they're going to be able to yield 70% on their crops, but they can't plant in preparation for next season. And obviously with, this is morbid, but with the, the dead bodies everywhere, that's going to create a problem that they need to get rid of in those fields before they can recultivate and do those things. So, they've got a lot of issues going on over there, plus all of the damage from weapons and, artillery and things like that. It's going to take some work before they can really, sow for the next crop. So those types of things are having an impact. And then, that's just right now without any escalation. And the issues with these impacts are also deglobalization. Another risk is deglobalization. So as Russia is isolated, other countries, that are potentially chiming in and not supporting, that are supporting Russia, not supporting the European alliance and things like that, can potentially get themselves isolated. So you're seeing some deglobalization start to happen where countries are saying, wait a minute, we can't be dependent on, these nations like Russia and China and these other nations. And so there's a big, deglobalization movement out there that could potentially weigh heavily on the economy as well. So those are just some of the risks right now without any escalation in terms of the conflict itself.
Okay. So, I mean, what you're saying, obviously the prices of goods are going to go higher because of the sanctions in place. This creates consumer uncertainty and that affects the markets. There's pressure on inflation as well. But I think, one of the key points you made is this is going to be a transient issue. Now, obviously there's global concerns, bigger concerns regarding, world war or nuclear war, things of that sort. And that will have a tremendously negative effect. But in general, and I'm going to share this graphic with you all, if you are watching on video, and I apologize for the way this looks. This was actually, we were trying to get the slides from this presentation that we sat through. We weren't able to, and these are just pictures of the slides. So it's a little skewed here. But basically what you can see is the G7 unemployment on the y-axis here and years on the x-axis. And as these different geopolitical events occurred, you can see that, unemployment sort of would drop and then it would rise and drop. And it wasn't necessarily correlated to these events. I mean, it's not like an absolute pivot point where these, cause something to go skyrocketing up or down. So, these are kind of generalizations, but in general, as Greg mentioned, geopolitical events don't cause long-term effects, but in the short term, certainly something to be very wary of and consider. Well, thanks, Greg, for that. And then
and they can be economic drivers because you have to replace all the munitions that are being destroyed and used. So, there's a certain amount of industry that will gain, from these issues, but we haven't seen anything like this since World War II. So you can't really measure the effects. It's just been so long. And it's a very different economy now than it was even in World War, even 20 years ago from a global standpoint. So we don't know. We just don't know what the effects are going to be. But generally, they haven't been that impactful.
Okay, and then let's move on to interest rates. Can you explain what's happening with interest rates and why they're increasing?
Yeah, so the Fed, has to. There are two mandates of the Fed: stable prices, full employment. So the only way that the Fed can impact prices is with interest rate policy. So they're having to raise interest rates to curb inflation, and the Fed thinks that the economy is strong enough, given the labor market, GDP growth, things like that, that they can raise rates significantly without impacting the economy. But we know that the only way that you can affect inflation is to create demand destruction, which means you have to slow growth. So you almost have to put the country, the world, into a recession in order to curb inflation because you have to reduce demand. So right now we have record demand, pent-up demand at all levels. We're a consumer-driven economy globally around the world, but the United States especially. So the only way to curb that is to raise interest rate, which tightens credit and reduces the amount of money that you can borrow to consume, because that's generally what people do is they borrow to consume. You're living on, not you specifically, but people, credit cards, equity from their houses, their stock portfolios going up, things like that, asset appreciation. It's basically a credit driven environment that we're in. Companies use credit to expand and grow and things like that. So the idea is to raise inflation so that credit markets tighten, the cost of borrowing goes up. So that should slow growth and demand enough to bring prices back into check. And the easiest way to see that impact at a real time pace, just look at the housing market, look at all the reports. The housing market is starting to slow down nationwide, and we're having, obviously there's, it's hyperlocal and there's pockets everywhere, but just with a 1% increase in mortgage rates, it's over 4% now. We're starting to see reports everywhere of record sales decline, pending sales decline, mortgage applications decline, all those types of things, around the world. If we get to 5%, or around the United States, we get to 5%, you'll see things just fall off a cliff basically in the real estate market.
Interesting.
Housing market.
Okay. Yeah, and I remember back in I think it was the 2000s, interest rate was around 8% at that time.
Yeah.
And that was the highest it's been for for as long as I can remember, and then it sort of slowly settled down and down. Historically, I mean, 5% historically is relatively low, correct? I mean, it
Yeah. Oh, it
potentially could go
is.
higher.
Yeah. I'm 54. My first mortgage was almost 10%. And, I was used to paying 6 to 10% for, most of my loans for commercial real estate and for development and then residential homes, year round primary residence. The problem is the biggest demand demographic for housing are millennials, and they haven't seen those rates. All they've seen is basically twos and threes. So,
Right.
it's that psychological threshold, number one, and it's affordability, number two, because prices have adjusted to the rates at, 2 and 3%. So, that payment, just to give you an example, if you can pay $2,000 a month and your loan after your down payment is at 3% is 474,000. At 4%, all you can borrow after your down payment for 2,000 a month, it goes to 418. At 5%, it goes down to 372. That's $100,000 difference in what you can buy. So that's what's happening is that, the millennials that are now the home buyers, they think that 5% is a bad interest rate because they've seen twos. So they're just like gas prices, right? Everybody's got this $3 threshold for gas prices. Anything under 3, we think it's good. You get over 3, we start feeling it. Now we're over 4 in most areas. Some areas are 5, 6, 7, but it's those psychological thresholds. But more importantly, in housing, it's payments. People are buying houses based on payments, and houses have inflated based on interest rates so artificially that it's flipping. Where it used to be cheaper to buy than to rent, now it's flipping back the other way around, where with mortgage rates where they are and the housing prices that that have skyrocketed so much, it's way cheaper to rent now than it is to buy in most areas. And that's going to continue to get worse as rates go higher, which housing will adjust to it, and it'll all come back down. It'll take a while in the resale market for retail homeowners, to adjust. But your home builders, that's where you're going to see the adjustment first, because what's happening, we're already seeing record levels of contracts falling out. So people contracting for a new house, when they get to the back end of that and they see where interest rates are now versus a year ago, they can't afford the house anymore. So they're backing out. So builders are going to be stuck with inventory. They can and they will liquidate inventory. So they'll be able to cut prices deeper and faster. So if you're looking to buy a house, give it about 6 months. Closer to the end of the year, if rates get up to 5%, builders will be dumping inventory at record levels. And that'll be the first adjustment, probably 20, 30%. You'll see them drop prices if they have to get rid of inventory.
Okay. That's a massive drop.
Yeah.
So just to sum that up, or to break it down to a nutshell, as we're seeing this inflation, the only way to stem that tide is basically to raise interest rates. And that's what's happening now.
Demand destruction.
Otherwise,
Yeah.
you'll have runaway
you have to
inflation.
impact demand.
Yes. Okay. And I'm going to share another graph with you.
Yeah, that's the only tool they have to fight inflation. They have there's nothing else they can do except make it more expensive to buy stuff.
Right. And then just as Greg was saying, you could see these are the 30-year mortgage rates for homes over the course of 2 years. And you can see that how they were dropping steadily at a nadir of around 2.7 there. And then now they're back on the rise. So that we're getting back to the early 2020 levels here. And
if you could overlay housing prices with that, you'd probably see the exact inverse of that chart.
I see. Okay. Excellent. And that brings us to inflation. So, you discussed what causes inflation, kind of injecting all the capital in the market. How do you think that it's going to affect the multifamily or just real estate market in general?
Right. So what drove inflation, was pumping. So from a commercial real estate standpoint, an investment standpoint, what drives inflation in assets, in the value of assets, is too much capital looking for too many places to go. And as treasury yields dropped, it forced capital into riskier assets like commercial real estate. That's an alternative asset class, a risk asset, and stocks. So what's happening is it drove the competition up for those assets. And at the same time, with record, with the low interest rates, the Fed was buying mortgage-backed securities. Okay. So that was giving Freddie and Fannie all of this liquidity that they had to put out into the market. And if you remember, you've probably heard from your lenders, yeah, we got $250 billion we got to put out this quarter. So that's loans that they have to make because the Fed is buying those. And when you have the largest buyer in the world of those assets, you got to put that money to work and look for those yields. So, that's what has created the inflation in assets, and specifically multifamily, because multifamily is seen as the safest asset class. It's equivalent to a bond, and they're priced cap rates versus treasury yields. that delta, that spread between treasury yields and cap rates is what those institutional investors look at because they want a reward for that risk. So the higher that gap is between treasuries and the cap rate, the more attractive it is to force that capital into the real estate. Now, what we've seen lately in the multifamily sector is it's almost become a tech stock play. It's almost become a tech play where they're looking at forward earnings, forward growth of that asset, because cap rates have come down so much relative to the yields on treasuries. It's only been about a 1% spread here in the last year, when it's normally about a 4 or 5% spread between 10-year and cap rates in commercial real estate and multifamily. And
Greg, could I interrupt just for 1 second? For those of you those of us who don't know what cap rates and treasury yields are, can you just give us a brief definition of those?
Yeah, so treasury, that's the 10-year treasury note, right? The 10-year treasury bond. So, right now, I don't know, they're 2.5%. They've been as low as like 0.9, I think, about a year or so ago. And cap rates that's what represents the yield of a return on a commercial asset if you were paying cash. So if a $1 million property has a 5% cap rate, that theoretically means if you pay $1 million in cash, you're going to get a 5% return on that cash, $50,000. So if you buy a bond that's yielding, 2.5%, you spend $1 million, you're going to get $25,000. So that's kind of how they look at it. I can buy a bond that's totally safe, that's going to yield $25,000 a year, or I can buy this multifamily property that's going to yield $50,000 a year, but I have risk because, it's not liquid like bonds. You can get in and out of those, instantly. Real estate's not as liquid, from the asset standpoint, but those yields have tightened. The spread between those yields have tightened to the point to where now what that investor is looking at is what's the growth of that asset. So they're measuring, future growth, especially in multifamily, versus what they can yield today. So it's a discounted cash flow moving forward. What's the value of that dollar that I'm investing in this asset moving forward? So it's a different game. And as treasuries rise, that gap is coming closer again. So it'll be really interesting to see how cap rates start to react and respond to that.
Okay. So that 10-year treasury and cap rate spread is something that people really focus on to see, potentially what could happen to cap rates, predicting into the future.
Yeah. And historically, you can go back and look at this and research it. For every 1% increase in treasury notes, the 10-year treasury note, that represents about a 0.3 increase in cap rates. So that's kind of how that's been relating. So about a 30% difference there. Okay.
Now, some people, the thought is that real estate is a hedge against inflation as well. Could you explain that?
Yeah, like we just talked about. So it's seen as a safe play that's going to grow over time and outpace inflation. So when you look at risk-adjusted returns and, inflation-adjusted returns, you got to back out inflation. Right now, unless you're taking real risk and developing, you're almost not going to outpace inflation. I mean, it's double digits, but basically that's what it is that you look at the return on that investment, you back out your inflation, you get that inflation-adjusted return. Historically, real estate's been the only thing that's outpaced inflation, over and over. Even the stock market hasn't really done it.
Okay. And I also want to share a graphic so those of you can see it. And exactly as Greg said, when you look at the long run capital values versus inflation, and this is hard to read, but there's office space here, retail, industrial, and then the black line here is inflation. So you can see, it's the red line that's inflation. So you can see that inflation's on a steady rise here. And these are over several quarters. This was back in the 1980s, but you can see how the capital values have outpaced inflation. That's typically what happens over time.
Yeah.
Okay.
And a hedge is protection. So just think of the word hedge, that's protection. How do I protect my cash against inflation, devaluation due to inflation? That's all that means.
Right. So, I mean, you have cash sitting there. If it's sitting in a investment or a savings account or whatnot, it's depreciating in value over time. I mean, so it makes sense to actually put it into some kind of investment that is hedging against inflation. Is that a good way to think about it?
Yeah, that's the thought. So, the thought is from a, safety standpoint, that's why treasuries can be so attractive, is if you have generally large sums of cash that you need to protect and you want to, put somewhere while you're waiting to deploy somewhere, you want to put it in something that's not going to devalue because of inflation. You want to put it in something that's either going to break even or grow against inflation. So, that's where you have to, measure how much risk am I willing to take for that. And that's where the whole conversation of don't fight the Fed comes from. Don't fight the Fed means don't fight them going up, don't fight them going down. In other words, right, the Fed has been the biggest buyer of treasuries, driving prices down, driving yields down on treasuries. So you don't want to fight that and try to outbid them. You go into risk assets. So that's what the Fed was doing. That's why the markets are up. That's why real estate's up, because the Fed's been pushing that capital into those assets. Now we're flipped. You can't fight the Fed on the way down when they're coming out, because now they're pushing you back into the safety trade and out of risk assets. That's why the stock market's deflating. That's why commercial real estate's going to deflate. That's why the housing market's deflating.
I see. Okay. And when do you see this happening? Like, how much time will this take before we start seeing this deflation? I mean, we're starting to see some of it now.
Yeah, it's happening now. The market was the biggest because the markets, they react quickly. So you're starting to see a little bit of adjustment there. You're seeing the bonds go up. That's a big forward-looking indication, and you're hearing a lot of talk about the yield inversion, the yield curve. So that's the spread between the 10-year Treasury and the 2-year, meaning short-term money should pay more than long-term money. Well, long-term money now is paying almost as much as short-term money. Once long-term starts paying more than short-term, that yield curve inverts, and that, over the history of the economy in the last 80 years, has accurately predicted recession every single time. But it could be 6 months or 2 years before that recession actually hits. So it may predict it, but we don't know when. So, when short-term money is looking for a safety play at higher rates than long-term money, that tells you there's a problem in the inflation that these investors are looking at. When I say these investors, I'm talking about what they call the smartest money in the world. That's sovereign wealth funds, life insurance companies, pension funds, the long-term investors that are annuities, that have to earn and have to preserve that capital base. If you look at where they're going, that's a good indication of what's happening. So we're already starting to see it now, but we're just at the beginning stages of the unwinding. So what we're seeing now is deflation. So inflation coming out of the economy, we're deflating, and then we have to reprice. So we haven't repriced yet. Remember what I said. So what's priced in the markets right now is the current rate hike and the current state of the economy. So we've deflated to that level. We have not repriced the real effects of inflation and the real effects of the war on the economy. And you're starting to see that in some companies reporting earnings. You'll see it there. You're starting to see it, interest rate rise and the housing market shifting, mortgage applications down, purchase applications down. There's more houses in the pipeline, more housing in the pipeline now than ever before. 2008 and 9, same thing. We had this huge supply coming onto the market. Then all of a sudden liquidity dried up. People couldn't buy, had all these houses hitting the market, destroyed it. We're not quite in the same position as we were back then because there's so much demand and so little inventory now, whereas we had tons of inventory back then. Average days on market for a house back then was about 6 months, and multifamily properties might take 6 months to a year to retrade. So, things are trading in days now. But, so those are the things that are already starting to happen now. And depending on what kind of a knee-jerk reaction we get at the next Fed meeting when they do a 50 basis point rate hike, which they're going to do, and announce, tapering of the assets that they purchased, releasing bonds and MBS back into the markets. The last time we saw that was 2017, 2018. The market sold off in a big way. The real question is the Fed going to step back in this time and reverse course? And we don't know. All we know is what they did last time. And depending on what they do will depend on the course of things moving forward after that. So we're going to learn a lot next month. Okay.
And one of my questions to you was about stock market volatility. And you really explained that in what's happening currently in the markets. But I mean, there's a lot of concern about what's happening. And is there any opportunity here? I mean, do you see anything, any positive?
In the markets right now, you buy the dip, you sell the rip. So on the way up the last 10 years, it's been buy the dip, hold, buy the dip, hold, buy the, it's been onward and upward, everything to the moon. Now, buy the dip, sell the rip. You don't stay in that position because markets are deflating and they're going to reprice. So the markets right now, some investors are still in the belief that the Fed is going to step in and not let the markets, reprice. That's what certain investors believe. The real smart money knows that the Fed has to let it go this time to a point. They might step in at a point, but they've got to let it go for a while. So, that's still, if you look at 2017, 2018, we still have 10, 15% from here down where the markets are to test the Fed's resolve and whether or not they're going to step back in. So we're not there yet. And, you'll see in bear markets, you see big violent bounces like we're seeing now, and you see real, extreme volatility. And, there's a different mentality now in the markets. A lot of it's algorithmic, a lot of it's, high frequency trading. But the biggest part of it is that psychology of everybody who's been conditioned to buy the dip on the way up because the Fed put was there. In other words, the Fed propping the market up. And that's not there now. But markets still don't seem to believe that it's not going to be there moving forward.
Okay. So the question is it going to happen? Is that quantitative tightening basically going to happen is what the question is?
Is the Fed, right. Number one, are they going to unload the balance sheet? Number two, are they going to not step in if the market sells off another 10, 15%? And the markets will test the Fed's resolve. It's going to happen. Okay.
So we were at a multifamily conference just about a couple of weeks ago, and we heard from several expert economists in the multifamily real estate space, not just multifamily, but just real estate space in general, commercial real estate space. And the projections were that 2022 was going to be a good year to invest in multifamily assets. The reason is, as you mentioned, real estate is a safe asset in inflation. There's a record housing shortage currently. The prices in housing, the housing prices are still climbing. They're leveling off, but they're still climbing. We're seeing lower cap rates, but they're offset by this tremendous rent growth. I mean, we're seeing in some of our assets, we're getting a 20%, 25% year over year rent growth, which is really unprecedented. And we're still, even this year, we're still seeing some of that high rent growth. And the projection is that we will continue to see some of that high rent growth. And then also there's unspent capital currently, the capital that's been injected into the economy. There's about $5 trillion that's unspent that people as consumers want to put out there. So there was some sense of opportunity and optimism that I got from that conference. But I just want to get your take on it because I feel like your take is a little bit more conservative and, not as optimistic.
Yeah. So real estate is an alternative asset class, and multifamily within that class of alternative assets is seen as the safest play in real estate. So that's why so much capital has been attracted to it over the last several years. And a lot of it has been life insurance, pension funds, sovereign wealth funds, like I was talking about, instead of providing mortgages, becoming the owners. So that was the big fundamental shift that we saw probably 5 years ago, where that really started to happen 4 or 5 years ago, where you really started to see cap rates decline. It's because of these big institutional buyers coming in when before they were just the loan, they were the lenders. So to your point, the caveat I will put on everything you just said is that it's hyper local. Not every single market is experiencing what you said. There's some that are experiencing the exact opposite. So the Sun Belt is where you're seeing record rent growth, record, housing shortages, record demand, record net migration. People are moving, Arizona, Texas, the Carolinas, Georgia, North Carolina, Charlotte, Florida. So that's where things are exponentially increasing. But what we're also seeing is, and what you really have to be in tune to when you're looking at assets, when you're buying and you're thinking about your portfolio, people are moving because rents are too high. So when rents, when their renewal comes up, and they're facing a $400, $500 rent increase because that's what you're getting from new tenants, people are moving. So you need to make sure you've got a big enough wait list, and you need to be testing that wait list. So keep raising rents every time somebody applies till you get pushback. And then well, that's as far as we can go. Obviously, you want to look at your comps and your competition and all that kind of stuff. But at the end of the day, it's what somebody's willing to pay. So if you just raise your rent quote every time somebody walks in to apply, as long as they're okay with it, you can keep pushing. But your existing tenants, you need to understand what the value of their leases are, what they're paying, and how much that represents as an occupancy level. And can you replace that? Because they will move, and they are moving now. People aren't going to move over $100. They're going to move over 300. Right. They're going to move over 500. And we're already seeing reports of that, especially in Florida, where they just can't afford it especially with inflation. That's what's putting the pressure on. So, I would just keep an eye on
Don't wages increase along with that, or with the increased wages, they're able to pay some of that higher rent?
No, I mean, inflation has way outpaced wage increases, especially with gas. I mean, the biggest, pressure on people right now is food and fuel. Those two things alone, wages haven't kept up with that at all yet. They were kind of there before the gas issue and before the food issue that we've hit. Once we get back to normal, get through the pandemic, supply chain opens back up, get the war, over with and all that, that stuff will level off. But right now it's putting tremendous pressure on people and the wages are not keeping up with it at all.
I see. I do want to share another graphic with you all about exactly as Greg mentioned, where demographics are reshaping real estate. Now, it is important to look at certain localities. I mean, if you're looking up here in the north, there is a less than 0% growth in some of these cities here. But as you go in the Sun Belt, which is this area here, you see these big green circles. There's a large amount of growth here. There's a huge influx in these cities. In fact, we were visiting Phoenix, and there just is not enough housing in Phoenix to maintain the population. There's a massive shortage. So there's tremendous growth here, in the Texas area, and especially Florida. And you're starting to see some of that taper in Florida a bit. Orlando still has great growth, but some other areas not as much. But these are, the Sun Belt here is exactly where people are moving to. Okay, so to sum it up, and then I'll open it up for questions. I mean, what would you recommend people to do with their money? I mean, if you've got cash sitting there, you don't want it to necessarily sit in an account with an inflation in an inflation type economy. What should people do?
So number one, you need to think preservation of capital first and foremost. So if inflation right now is a real risk against capital, it's eroding it, but that doesn't mean you have to deploy it and you have to put it work. So don't feel like you have to deploy just because of inflation, because that'll cause you to make some mistakes. And just understand where we are in the markets in terms of the risk that you're willing to take and what you're willing to deploy that capital into. And cash is king in economic turmoil. At the end of the day, cash is king. So you want to have a certain amount of cash available to take advantage of some opportunities. So when you see big sell-offs in the market, that's the time to get in and make some plays. Now, it might just be short term. Again, buy the dip, sell the rip. That's the kind of market we're in right now. We're not expecting at this point in this environment with the 5 risks to the inflation that I just, I mentioned at the beginning, those 5 risks that we're facing. Until those are gone, you can't expect a bull market. You just can't, because that was off the back of the Fed. So right now you got to play it the other way. And if you're looking at, investing in real estate or something like that, it just needs to make sense. You need to make sure that if you're forward looking, in other words, if the deal is, hinging on being able to increase income, you need to make sure that you can actually do that. And you need to understand, if inflation gets a little bit worse, hard to imagine it getting much worse than it is right now, but it can get a little bit worse before it gets better. Are you going to be able to do that? You're going to be able to increase rent. You're going to be able to increase the income, those types of things. Interest rate is a real risk. So you need to understand if you're buying property, what's your maximum that rate can go to. So you want to make sure you got rate caps on all your loans. If you're doing short-term floating, debt, something like that, make sure you get a rate cap, buy a rate cap, whatever you need to do. If you're getting long-term, then you're fine, but you got to hedge that way with, longer term debt or rate cap so that your rates can't go up by so much. And I don't see, rates getting back much higher than, 5 or 6% from a real interest rate standpoint on commercial loans and residential loans. So, if you're factoring in normal stress testing, you're almost at those levels anyways, based on current rates. So, just have those discussions with your lenders, make sure you understand what they're seeing, what their rate projections are, things like that. But, don't feel like you have to do anything, but be ready to take advantage of opportunities because there's plenty of them out there right now.
Okay. So just to sum that up, preservation of capital is key, right? So you want to maintain some cash in the event that there's an opportunity to invest in. And it's, if you feel that you're investing in a solid sponsor in an area that is growing, maybe instead of a rent by necessity, but a rent by choice type opportunity where, you have tenants that can handle the higher hikes in rents, then that potentially would be a good investment. And that would be a good hedge in this type of environment.
Absolutely.
Is that fair to say? Okay.
Yeah. Multifamily has been your safest bet. Then you got self-storage behind that, and industrial, industrial's right up there.
Great. Well, Greg, that was an awesome overview. I mean, there's a ton of information that we covered here, and it was a really excellent overview of where we are today and kind of, what we should anticipate in the next several months. And I just want to open it up to questions right now. So we've got a few questions. Nathan, feel free to unmute and then ask any questions that we have.
Yeah, I see one from Maria Wong. Would you say that it's more prudent to invest in a project with a 10-year project projected hold or a 5-year hold? I would look at that 5-year hold. What is the risk? And do they have to exit by 5 years? Can they go 10 years? So, it really 10 years doesn't mean really a whole lot unless it means it's going to take 10 years for that, investment to play out. So that's kind of what I would look at. And it's really up to you. Can you stay in it 10 years? Does it have to go 10 years in order for it to perform? That's kind of how you want to make that decision. It's really up to you in terms of when you need to exit and what you think your returns are going to look like.
Excellent. Thank you. Any other questions?
And then one thing I'll say for anybody who's in the stock markets, keep your eye on tech. Tech has drawn down quite a bit. It's been beat up. There's going to be a lot of opportunities in tech stocks. And, maybe not right this minute, but I'd keep your eye in that sector. There's going to be a lot of opportunities there. A lot of good companies that have been beaten up just because of the risks, that we talked about earlier.
Are there any ones that you think people should be focused on?
I'm not going to get into all that. They got to, kind of take a look at it and understand where the good companies are. Cause there's the meme stocks, you got AMC and GME, and they're kind of all over the map, but companies like, Facebook and Zoom and DocuSign and, company PayPal, companies like that, they're Apple, and Amazon, good companies that, are going to be here and have good earnings that just been beat up just because tech's been beat up. Now, that doesn't mean they're going to go back to where they were. It just means that they've dropped, some of them, 70, 80%. There's probably a little bit more downside to them because they're repricing back to normal valuations based on, trailing earnings and future earnings. And it was the pandemic play. A lot of the pandemic stocks, the stay-at-home stocks that went through the roof are all repricing and, coming back down to earth. And, they'll pick up some steam as we move forward, because those were good investments to begin with, and they're not going anywhere. They're good, solid companies. But I would just look at that, use the Warren Buffett theory. What are you using every day, in your life from a digital standpoint, from a consumer product standpoint? What do those companies look like? What is the pricing on their earnings? And, look at those ratios, and you just want to make sure you're buying value. So we're back to value now, where it was all, these exponential projections in 5 years, with tech stocks.
Okay, excellent. We have a question from Sia, who has mentioned that, and I'll read his question. He says, we have scaled very quickly over the past few months with assets under management around 215 million through partnership, co-sponsor deals. It seems challenging finding good deals that pencil in our target markets. What are your suggestions to help us be aggressive and take down 2 deals in 2022?
Yeah. So number one, run them by your lender first. So let your lender take a look at them, see what they think, see what they suggest. It's very difficult. You have to get adjustable rate, interest-only loans to maximize cash flow right now. And then again, it's all future projected earnings. A lot of competition for the assets, but at the end of the day, you got to be making a lot of offers. That's what it takes. You need to expand your geography, be looking at more markets, make a lot more offers to be able to get a good look at a lot more deals. And then think about how you structure your deals in terms of your equity splits, returns, things like that. You got to get creative with those structures in order to make the deals work. And it all depends on what your goal is. So if you're a fee-based operator, in other words, if your living is made on fees versus, equity right now or cash flow, that's okay. That's a service you're providing to your investors, but you need to understand what your business model is, what your needs are, and can you, generate the returns for your investors and yourself over time. So then you can adjust, the equity splits, preferred returns, things like that, however you need to kind of make those deals work. But you need to be careful and, make sure that you understand that you can definitely hit those benchmarks and, increase the income, because at the end of the day, that's what it's all about. It's decreasing expenses and increasing income that drives the value of the property.
Excellent. Thank you. Marina Wong has a question, sort of more of a statement, but I think she was asking a question here. It says most 5-year hold projects use variable rate bridge loans and interest-only payments. Is the risk to these the refinance in 5 years?
Yeah, absolutely. Because you don't know, number one, is liquidity going to be there? Because as credit tightens, lending tightens. So, you don't know what 5 years is going to look like. And, you want to make sure that you have a rate cap. So like I said, if you're doing a 5-year adjustable interest only, variable rate loan, you want to make sure you buy a rate cap so it doesn't go through the roof on you if the Fed, decides to get happy and really drive rates up. And, they can only go up so fast. So you can kind of stress test that and make sure it works. But there is risk in a 5-year interest only at the back end of whether or not you're going to be able to refinance that asset. And if, depending on what the credit markets look like at the time, what the requirements are going to be. As we saw, a recent example was the pandemic, right? Credit requirements changed, reserves, interest rates, all of that. Some lenders backed out of the market completely. So you saw how quickly credit can dry up for these assets and how, lending can dry up for these assets. So you just need to understand there's a risk in every asset, in every market. You just need to understand it, be able to adjust when you get there. And also, worst case scenario, you get the end of 5 years and lending dries up and credit markets dry up. These lenders aren't going to take the asset back. They don't want bad assets on their books. They'll work with you. They might extend, things like that. But you might have to bring more capital to the table. You might have to, there may be some other things they want you to do, but they're not just going to take it from you necessarily unless the world's coming to an end and the bank's failing.
Okay, that's a good tip. Next question. Greg, you mentioned that wages are trailing inflation by a long shot. Do you see any increase in wages in the coming years to combat the difference? If so, what would be the catalyst for that change?
Yeah, so it's already happening now. So service industry, I heard an interview today with the owner of Le Bernardin in New York, one of the finest restaurants in the world. And he's talking about his issues with staffing. So he lost a bunch of his staff in the pandemic and he's having to pay, 20 to 30% more now to get more staff and get new staff. So, with fuel prices, we're seeing everybody having to raise their prices. And with the labor market, there's more jobs than there are workers. So companies are having to entice people with bonuses, with higher wages to bring them in. Google had a meeting the other day responding to a survey they sent out to their company, and everybody is asking for wage increases. So we're seeing it now. So the employees are starting to understand the leverage that they have, and they're pressuring their companies to raise wages. So it's happening, and it could potentially catch up a little bit, but it takes a little bit of time for that to happen. And, hopefully inflation will level off here, pretty soon, and we'll have an understanding of where the ceiling is on that. And then wages can then start to slowly catch up with that, but they're sticky. So the thing is that, only so much inflation is going to taper, because as wages go up, well, that, cost of goods goes up and they have to pass that on to the consumer. So we're kind of in that area where things are going to escalate and just kind of stay there for a while. Very difficult for wages to go backwards unless the dynamic completely changes, the market completely changes and companies start laying off, which we could potentially see, because the biggest risk we didn't really talk about right now is stagflation. So that's, high inflation, low growth. So with what the Fed has to do, they have to create demand destruction in order to correct inflation. So the risk is you go too far and then you slow growth to the point to where they start, companies start laying off and they stop producing, or they, realize how profitable they are running as lean as they are, and they produce less to keep their prices up. Then that can eliminate jobs. And then you start to get a reversal in wages. But right now it's already starting to catch up, trying to, but it's still behind a little bit.
Yeah, and from my experience in Atlanta, where we have most of our properties, we are constantly battling with maintaining our employees and staff on site. Many of them are leaving for higher paying positions, same position, but like a 20-30% wage increase. And we are also giving our employees wage increases. So, and we're seeing it across the board in Atlanta. And some of these positions like maintenance techs and those types of people, they actually are, we're doubling their salary, in fact, from what it was just a couple of years ago. So certainly we're seeing that.
Yeah. Interesting times.
Yeah. Okay. I think that's about it. Well, thank you, Greg. This was very informative, and really appreciate your time and energy in educating all of us.
Yeah, absolutely. And again, I'm positive, I'm opportunistic. So, bad times never last. Good times never last. This is just cycles. You just need to understand them, and you buy the dip, you sell the rip.
Yes, absolutely. Wonderful. Thank you so much.
All righty.
Thanks for listening to the Viking Wealth Show, the show that inspires you to feel knowledgeable, courageous, and skilled in your passive real estate investing decisions. Join our Viking Investor Club on our website, vikingmultifamily.com, to gain access to our amazing investment opportunities. Make sure to also subscribe and leave a comment for what you would like to see in our future episodes.